Aptos has a lot of good financial tools like DEXs, liquid staking, lending and borrowing platforms, as well as yield farming. But you know what's missing in the Aptos ecosystem? A good options trading platform. So let's build one. Hi everyone, this is Neha and welcome back to my YouTube channel. Today is going to be the first episode of building our own decentralized options trading platform on Aptos blockchain from scratch. So in this first video, we're going to talk a little bit about what options actually are. We'll be giving you some real world examples as well as talk about the data structures that can enable us to build something like this on Aptos Move. So let's get started. So what are options? So options are financial derivatives that give the buyer the right but not the obligation to buy or sell an asset at a given predetermined price, which is also known as the strike price, before the specified expiration date. That sounds like a lot of jargon. Let me break this down by taking two simple examples. The first one, let's talk about this wheat farmer named Sam. It's currently springtime, and Sam is setting up the wheat farm to be harvested in fall. Now, the current price of wheat right now, $8 per kg. But Sam fears that by the time fall comes into play, there would be a lot of supply of wheat, and hence the wheat price will go down. So Sam decides to strike up a deal with a food processing company. The deal is structured like this. Sam pays the food processing company an upfront premium of $1,000, which gives Sam the right to sell 10,000 kgs of wheat to this food processing company at the rate of $7.5 per kg. Now, a few months down the line, there are a few different scenarios which can happen. Scenario number one, the price of wheat actually falls as predicted by Sam. Let's say it goes to $6 per kg. Now, Sam, because of paying the premium of $1,000 and having bought this option, now has the right to sell 10,000 kgs of wheat at the price of $7.5, equivalent to $75,000 of revenue, compared to a revenue of $60,000 if he would have sold the wheat later in the open market. So the total profit made by Sam here is 75 minus 60 minus $1,000, which Sam put as the premium to buy the option, which is $14,000. But what happens if instead of this, the wheat price actually soars up at, let's say, $9 per kg? Now, because Sam has bought an option, he does not have an obligation to sell this to the food processing company, meaning that he can still decide to sell 10,000 kgs of wheat in the open market, making $90,000 minus the $1,000 that he paid as a premium to the food processing company. So by exercising options, Sam is actually able to limit the risk or the downside of this trade. Since here Tam is trying to buy the right to sell his product to a particular entity, this is actually known as a put option. Now let's take example number two. Imagine a sneaker store, and we have Mr. Jordan as the manager of this sneaker store. Mr. Jordan has very good connections with wholesalers and distributors from all over the world, and he has his eye on this beautiful pair of limited edition sneakers. So the current retail price for this pair of sneakers is $200, but Mr. John, being the ultimate collector, has a feeling that this price will rise up in the secondary market. So Mr. Jordan strikes up a deal with one of the distributors, paying them a premium of $50 per pair of sneakers to buy these pair of sneakers at $250 when it is launched. And again, there are two scenarios that can happen in this situation. The price of the sneakers shoots way up as imagined by Mr. Jordan. Let's say it is at $500 on the secondary market. Mr. Jordan ends up paying, let's say, $50 premium for 10 pairs of shoes, that is $500 as premium, but Mr. Jordan is able to sell all of the shoes for $5,000. So the total premium that Mr. Jordan ends up paying here is $500, and his total purchase value of the sneakers is $2,500. So the total profit that Mr. Jordan ends up making is $5,000 minus $2,500 minus $500, which gives him a net profit of $2,000. And the second scenario is when the sneakers flop on the market. They don't do that well. They maybe get listed for, let's say, $180, and seeing that Mr. Jordan decides not to exercise the option to buy these sneakers at $250 per pair, and just instead ends up losing his premium amount, which was a total of $500. And since in this case, Mr. Jordan is actually buying the right to buy sneakers at a particular predetermined price, this is known as a call option. So far, we have discovered there are two categories of options: call options, which give you the right to buy certain specific asset at a given strike price within a given duration, and second, a put option, which gives you the right to sell a particular asset at a given strike price within a given duration. As we saw in the call options, we are actually anticipating the market to go higher, and that is when we end up being profitable, whereas in a put option, we actually want the market to be bearish and the price to fall in order to make a profit. And in both the cases, the option seller is actually taking on a risk, and for this risk, they are getting a premium in return. So why are we building this options trading platform on blockchain? So traditional option markets have a lot of limitations, most of them being that they're only open for some specific set of investors. They're not accessible 24/7. They have high fees, counterparty risk if the other side can't pay up. And blockchain can actually solve for most of these issues by allowing a 24/7 market, accessible to everyone with transparent pricing and execution, reduced counterparty risk through smart contracts, and automated settlement without middle parties. So that's it for this one. In the next video, we'll be starting off with our smart contract. Super excited for that. See you then. Bye bye.